Welcome to the Explainer. So, PayPal, it's a company pretty much all of us use, right? But here's the thing, its stock has been in an absolute free fall. Today, we're going to dig into their huge and maybe a little risky new strategy to turn things around. The big question is this: can becoming a bank actually save PayPal? Okay, let's just dive right into the central puzzle here, because it's a weird one. You've got this massive disconnect between how PayPal, the company, is actually doing versus how its stock is performing. And for a lot of people, it's a real head scratcher. So to really wrap your head around what's happening, you've got to look at this as a tale of two completely different PayPals. There's the story of the company itself, and then there's the story of the stock, which, well, it's not a happy story. I mean, look, if you pop the hood on the company's finances, everything looks pretty solid. It's cranking out strong, growing free cash flow. Its long-term debt is totally manageable, and they're even consistently buying back their own shares. But then you look at the stock, and oh man, it is a horror story. A colossal price drop, it's been stuck in the mud, trading flat for what feels like an eternity. It's just been incredibly painful for shareholders. So what is going on? What's causing this huge divide? Well, it seems like the market has tunnel vision. Wall Street analysts are laser-focused on one specific thing: the growth of PayPal's branded checkout services. That's when you see that classic Pay with PayPal button on a website. It's their most profitable business, and right now, its growth is slowing way down. So with all this pressure, PayPal is making a really bold move. They're trying out a radical treatment for their SIX stock, and it's a big one. They want to become a bank. So what's the plan? Well, they've officially submitted an application to create their very own industrial bank. The goal here is to supercharge their small business lending, which is already a huge part of what they do. I mean, to put it in perspective, they've already loaned out over $30 billion to small businesses since 2013. This is not a small operation. And you know who's leading the charge on this? The new CEO, Alex Chris. And this makes perfect sense because his whole background is in small business services. He believes this is an absolutely crucial step to make PayPal stronger, more efficient, and better able to support the merchants who are really the lifeblood of the entire platform. Okay, but what exactly is an industrial bank? It's not a term you hear every day, right? So let's break down what this thing, this ILC license, is and why it's such a potential game changer for a company like PayPal. So, an industrial loan company, or ILC for short, is basically a state-chartered financial institution. The easiest way to think about it is as a bank light license. It lets a company act like a bank, make loans, that kind of thing, but with way, way fewer regulatory hurdles than a traditional bank has to jump through. Now, the key difference here is that regulatory burden, it's just so much lower with an ILC. But the real game changer, the secret sauce, is that the parent company can be a commercial firm, like PayPal. It doesn't have to be a formal bank holding company. This is the special key that unlocks the door for a tech company to get into the banking business. And the whole reason for doing all this, it boils down to one fancy financial term: accretive. But all that really means is that this move is specifically designed to make the company more profitable and boost its earnings per share. It's all about the bottom line. So here's how it works in practice. Right now, when PayPal makes a loan, they have to use a partner bank. And of course, they have to give that bank a cut of the profits. By becoming its own bank, they get to cut out the middleman. This lets them lend out multiples of the cash they have on hand, which will dramatically, and I mean dramatically, boost the profit they make from every single loan. But, and this is a big but, this is not a magic bullet. This is not a quick fix. And to get a realistic idea of the timeline here, we can just look at another fintech company that went down this exact same road a few years ago: Block, who you probably know better as Square. Just take a look at Block's journey. It took them 3.5 years from their first application back in 2017 to finally getting their bank launched in 2021. This is not a fast process. It's not a simple process. Now, the good news for PayPal is that they aren't the first ones through the door. They can learn from Block's experience, and thankfully, some of that federal red tape has been cleared away since then. So while the process should be faster, they're still looking at a journey of about 2 years. A long haul. All right, so let's bring it all together. Let's get to the final verdict and answer that big question we started with. Can this whole banking strategy really save PayPal? Well, the verdict seems pretty clear. In the short term, the answer is no. This strategy is not going to touch their earnings for at least 2 years, so it's not going to move the needle for those analysts who are obsessed with branded growth. Not anytime soon. But here's the thing. This was never a short-term play. It's a powerful long-term prescription for the company's future health, designed to become a huge source of revenue years down the road. And that really leaves us with the final crucial question. Think of it this way. PayPal is planting a tree that promises to bear some very profitable fruit in the future. But in a market that's obsessed with what's happening next quarter, will investors have the patience to wait for the harvest? That is the billion-dollar question.